90% of your financial decisions are not made by your logic. They are made by your emotions. That's not an opinion. That's the conclusion of Nobel Prize-winning psychologist Daniel Kahneman after decades of research on how the human brain processes money. And here is the part that should make you stop. Losing $1,000 does not feel the same as winning $1,000. The pain of the loss is psychologically twice as powerful as the pleasure of the gain. Twice. And Wall Street has known this for decades. They didn't just discover it. They built their entire system around it. Here is the question I want you to hold for the next 10 minutes. If Wall Street understands your psychology better than you do, and they do, then every time you panic sell, every time you buy at the peak, every time you hold a losing position too long, who is on the other side of that trade? By the end of this video you will know exactly how this mechanism works, which specific decisions it is controlling in your portfolio right now, and the three-rule system that neutralizes it completely. Stay with me. Because what comes next changes how you see every financial decision you have ever made. In 1979, Daniel Kahneman and Amos Tversky published a paper called Prospect Theory. It became one of the most cited papers in economic history. The core finding was simple and devastating. People do not evaluate outcomes based on absolute value. They evaluate them based on gains and losses relative to a reference point. And losses hurt more than gains feel good, by a factor of approximately 2 to 1. This means that losing $500 feels roughly as bad as winning $1,000 feels good. The math is the same. The emotional experience is completely different. Kahneman called this loss aversion. And it is not a personality trait. It is not a weakness. It is a hardwired feature of every human brain, the result of millions of years of evolution where avoiding loss was more critical to survival than capturing opportunity. The problem is that evolution built your brain for a world of physical threats, not financial markets. And Wall Street figured that out long before you did. In 2021, retail investors poured $900 billion into equity markets, the largest single-year inflow in recorded history. The S&P 500 peaked in January 2022. By October 2022, it had dropped 25.4%. Retail investors pulled $300 billion back out near the bottom. Institutional investors absorbed every dollar of it. That was not coincidence. That was loss aversion working exactly as designed. But here is what most behavioral finance videos won't tell you. Loss aversion doesn't just affect when you sell. It controls what you buy, how long you hold, and how much risk you take, at every single stage of the investment cycle. And I'm going to show you exactly how in the next 2 minutes. Most investors think loss aversion only shows up during a crash. They're wrong. Loss aversion operates continuously, and it creates 3 specific, measurable distortions in investor behavior that cost the average person hundreds of thousands of dollars over a lifetime. Distortion 1, the disposition effect. Investors sell winning positions too early and hold losing positions too long. Why? Because selling a winner locks in a gain that feels good but small. Selling a loser locks in a loss that feels catastrophic. So investors hold losers, waiting for them to come back, while cutting winners that still have room to run. A 2011 study from the University of California analyzed 10,000 brokerage accounts over 6 years. Investors who held their losers longest underperformed the market by 3.4% annually. That gap, compounded over 30 years, is the difference between retiring comfortably and running out of money. Distortion 2, risk aversion asymmetry. After a loss, investors become dramatically more conservative, moving to cash, avoiding volatility, reducing position sizes. This happens precisely when markets offer the best entry points. After a gain, investors become overconfident and take excessive risk, precisely when valuations are stretched and downside is highest. The behavior is the exact inverse of what produces returns. Distortion 3, the break-even effect. When investors are deep in a losing position, loss aversion paradoxically pushes them toward higher risk, not lower. They take desperate bets to get back to zero. This is why retail investors buy more of a falling stock at lower prices, not because the thesis improved, but because the brain cannot tolerate crystallizing the loss. These 3 distortions are not random. They are predictable, repeatable. And the institutions that operate at scale, the hedge funds, the market makers, the algorithmic traders, have built systems specifically designed to trigger all 3 simultaneously. Stay with me. Because what I am about to show you is the single clearest real-world example of how this mechanism was used to transfer billions of dollars from retail investors to institutional accounts, in a single 48-hour window. And most people who lived through it still don't know it happened. March 16, 2020. The S&P 500 drops 12% in a single day. The largest single-day drop since 1987. The VIX, the market's official fear index, hits 82. The highest reading in its entire history. CNBC is broadcasting live. The headlines say the financial system is collapsing. Your portfolio is down 30% from its February peak. Every signal your brain receives says the same thing. Sell. Get out. Preserve what is left. And millions of people did exactly that. Between March 9th and March 23, 2020, retail investors sold $326 billion in equities. The highest sell volume in market history. Every single one of those trades had a buyer on the other side. BlackRock purchased $1.1 billion in equity ETFs in a single session on March 18. Vanguard reported record institutional inflows the same week. Warren Buffett's Berkshire Hathaway held $137 billion in cash going into the crash, and began deploying it systematically as the VIX peaked. The market bottomed on March 23, 2020, 4 days after the peak retail selling volume. The S&P 500 then returned 67.9% over the next 12 months, the fastest recovery in the index's history. The retail investors who sold at the bottom and waited for things to feel safe again, most of them re-entered the market in late 2020 or early 2021, at the top, triggering loss aversion a second time. This is not bad luck. This is loss aversion executing a perfect, repeatable cycle. Fear peaks. Retail sells. Institutions buy. Market recovers. Retail buys back at the top. Institutions begin distributing. Fear peaks again. The cycle has repeated in 1987, 2001, 2008, 2020, and 2022. It will repeat again. The only variable is whether you understand which side of the trade you are on. So back to the question we started with. If Wall Street understands your psychology better than you do, who is on the other side of every emotional trade you make? Now you know the answer. And knowing it changes everything. Loss aversion is not going away. It is built into your brain at the hardware level. But it can be neutralized, not by becoming emotionless, but by building a system that removes the decision from your hands at the exact moments when loss aversion takes control. 3 rules. Written down before the market opens. 1. Never sell a position during a VIX reading above 30 without a 48-hour waiting period. 2. Automate your entry points with limit orders set during calm periods, not reactive market orders during volatility. 3. Define your exit criteria before you buy, not after the position moves against you. These rules do not require discipline in the moment. They require discipline once, when you set them. After that, the system overrides the biology. The investors who build wealth over decades are not smarter than you. They are not more disciplined than you in the moment of fear. They simply built better systems before the fear arrived. Wall Street is counting on your loss aversion. Every quarter, every cycle, every crash. The question is whether you give it to them. If this video showed you something real about how markets use your psychology against you, hit like and subscribe to Fiscal Mind. Every video on this channel is built on data, not opinion. The next one goes even deeper. I'll see you there.